Thank you. Then we'll move to the next slide. Welcome to the another video. We'll be looking at the different types of analysis, financial statement analysis. The next one is cash flow analysis. This method examines the cash flow statement to assess how well a company generates cash from its operations and manages cash for investment and financing. It helps assess liquidity and long-term solvency by focusing on actual cash movement rather than accrual accounting measures. Analyzing operating cash flows to assess whether the company can sustain its operations without external financing. Funds flow analysis. It looks at the sources and uses of funds over a period to understand changes in working capital. It helps in identifying how a company manages its financial resources, especially in terms of working capital. Analyzing the flow of funds to identify potential liquidity issues. Next one is segment analysis. This involves breaking down financial data by business segments, product lines, or geographic areas. The purpose of this is to help in understanding the contribution of each segment to the overall financial performance. Example, evaluating the profitability of different geographic segments for a multinational company. Then a quality of earning analysis. It assesses the reliability and the sustainability of a company's earnings by examining its accounting policies and management practices. Helps investors and analysts to determine whether reported earnings are of high quality and free from manipulations. Scrutinizing revenue recognition policies to see if company is inflating earnings. The next financial statement analysis is benchmarking. Definition compares a company's performance metrics with those of industry peers or specific competitors. Identifies areas of strength and weaknesses of relative to competitors. The example we can say comparing operational efficiency, that is profitability. Comparing operational efficiency ratios like inventory turnover ratios to industry averages and profitability ratios and etc. etc. These various methods provide a comprehensive view of a company's financial health, allowing investors, managers, and analysts to take informed decisions. We'll be looking at the income statement, the overview of income statement. Income statement is a report card of a business. It tells whether the company is making a profit or loss. It is the financial performance of a company. Obviously, it is a periodical statement. Since it is prepared based on the transactions of the last 12 months. For the 12 months period, it is prepared. What is happening? How much based on the purchase and sales, based on the transactions, receipt and payment, that is the revenues and the expenditures for the last 12 months, it is prepared. That's what is called as a periodical statement. It's used for reporting a company's financial performance, whereas the balance sheet is a snapshot. It is a statement on a particular period, balance sheet. Whereas the profit and loss account, that is income statement, is a periodical statement. Balance sheet focuses on the financial position, whereas the income statement focuses on the financial performance. Then net profit or net income arrived by subtracting the total expenses and losses from the total revenue. The total revenue is the sum of both operating and non-operating revenues. See, operating revenue means whatever the income that the company generating through its core activity. Core activity means main business.